Okay, let's go over the questions together. So if you didn't get some of the concepts earlier, this is a great chance for you to catch it now. Let's go over the questions together. Okay. Now the first one here, for those of you that has AC versions, it's number 1. If you have BD versions, it's number 6, this problem. Okay, now which of the following would be true for a computer manufacturing company? So AC will be number 1, BD will be number 6. So the ones in the brackets represents BD versions, question number. Okay, so this question here, which one is true for manufacturing company? ABC Systems helps the company to make more informed decisions about products. So what's wrong with the rest of it? A and B. Manufacturing computers use only a few activities, so a company-wide overhead allocation rate would work well. This is not correct because this is inferring that using one single allocation rate is right. Which in reality, a lot of the companies has multiple stages in their production line. It's better to use multiple activities and multiple allocation rate to allocate manufacturing overhead cost. Okay, that's the incorrect portion of A answer. And B answer, most of the company's costs are for direct materials, direct labor. Indirect costs are a small portion of total cost. Again, this is a question from the book, so it's not a small portion. Indirect costs is just the ones that are hard to assign to different activities, but they are not a small portion. Okay, some of them, add them together, depreciation, taxes, could be a large portion. It's just that we're trying to find a rate to allocate them. Okay, so this question answer is C. ABC helps the company to make more informed decisions because it provides more information on specific stages of the production cycle. Okay, the second question, the service company provides e-learning services, and here's some of the information listed. Service revenue, operating expenses, net income, number of services. So if they ask you, if you want to pick up your exam, unit cost per service call. So the unit cost here is the price, basically the expenses you spend in order to provide the service. Okay, so we will be using operating expenses and then equally spread them out to the number of service calls. So there are 21,000 service calls here. The total expenses used in order to make this service possible is $15,750. Okay. So you'll be using the total expenses and divided by 21,000, the total number of calls. Yes? I'm sorry? Oh, BD version is 7, yes. Okay, so unit cost per service, if it's unit cost per manufacturing company, you'll be adding up the total expenses. Remember, for manufacturing company, there will be 3 types of expenses, of cost, basically, of producing the products, and you divide it by the total units. Here we're talking about service. We're not referring to any inventory cost or manufacturing cost, simply operating expenses. Okay, third question, and for BD versions number 8. Companies enjoy many benefits from using JIT, just-in-time system. And which of the following is not a benefit of adopting JIT? C, the ability to continue production despite disruptions in deliveries of raw materials. Okay, so if you haven't picked up your exam, come to the front. So this one here, AB is the advantage of JIT. Lower inventory carrying costs, more space available for production. Those are advantages of using JIT. Remember, we only start production line when customers' request comes in, when people order the company's products, then you start the mini production line and immediately ship out small orders. So once it is done. So we don't store up finished inventory. We don't purchase a whole lot of direct materials up front, but we only purchase the ones that are enough for small production cycles. Okay, so not a benefit. in case that you don't have a strong relationship with suppliers, with vendors, this will be a disadvantage for using JIT. Okay, the fourth question. This accounting firm expects accountants to work a total of 24,000 direct labor hours a year. Now the cost for an hour rate of work is $75, and the estimated total indirect costs are $240,000. Okay, so if this company requires a job, this job requires 40 hours of direct labor, what will be the total job cost? So notice here that this is a service company, but again, it also has the direct portion of the cost and the indirect portion. So it tells you that the total labor hours estimated is 24,000 hours, and the cost rate is $75 per hour. However, this job only uses how many hours? 40. So to calculate direct cost, 40 multiplied 75 will give you the direct portion. Now what about indirect cost? Indirect cost, we know the total estimation part is $240,000, and we also know the total labor hours is 24,000 hours. So you can calculate the indirect cost rate and then multiply 40. Okay, remember for service company, usually we only allocate the hours allocate the indirect cost based on labor, because we're not producing products, so we don't have specific stages of activities in production cycle. Really the only allocation rate will be used is the labor hours. Okay, so the direct labor cost part, just multiply 75 by 40, get the direct portion. Indirect cost, you have to calculate an indirect allocation rate first, based on the total indirect cost divided by the estimated hours in a year. So you figure out the indirect cost rate is $10, then you multiply that $10 by 40 hours. Okay, so the direct portion really is the hours that perhaps the staff spends with the client on figuring out things. Indirect cost is all the other stuff. All the other expenses incurred, operating expenses incurred in the business, and you still have to consider them, but you allocate it based on also the labor hours incurred. Okay, so if we add both of them together, $3,400 would be the total job cost. Okay, next question for AC version number 5, BZ version, first question. Which of the following is part of operating expenses, or we can call it period cost, but not part of manufacturing overhead? This one should be easy. Which one is not part of manufacturing? It's the advertising cost. So this is part of the what? Period cost, operating expenses. Okay, so anything without the term manufacturing, without the term factory related, falls under period cost, operating expenses. Okay, let's take a look at number 6. Following information relates to Bright Toy Company's operating activities. The company sells light box toys and sold 10,000 units. So what is the cost of goods sold, and not in total amount, just per unit's cost of goods sold? So the first question would be how to calculate cost of goods sold, right? So how do we calculate cost of goods sold? We will start from beginning inventory, 14,000, and new purchases, 126,000, and then what do we do next? Subtract the ending inventory, 10,000. Okay, so how much is cost of goods sold? 130, and that's the total amount. The question is asking you per units, right? So then you divide that by the total units sold or the total units produced, 10,000 units. Each of them, cost of goods sold is $13. Okay, number 7, in computing the cost of goods sold, which of the following is the manufacturer's equivalent to merchandiser's purchases? Say cost of goods manufactured. Okay, doesn't this problem look familiar and very friendly? It's from the book. Okay, in the back of the book, multiple choice questions, one of them. So purchases, merchandisers, they pay the money to vendors, suppliers to purchase items and then resell it to customer. If you mirror that to manufacturing companies, they don't purchase well-done materials, but they actually manufacture their own. So once the goods are manufactured, then they sell it to customers. So the purchases part, we directly sell it to customers for merchandisers' business. For manufacturing business, they produce the products, and once it's finished, that's the cost we call cost of goods sold manufactured. Later will turn into finished goods. Okay, number 8. This company reports cost information for August, and what is the amount of direct materials used? So how do we get direct materials? Again, we start from the beginning, work in process, and then, so this question, if it's asking you direct materials, that means from this information here, we're trying to parse out the middle part of the equation. This problem here gives you work in process in the beginning, gives you work in process in the end, and the portion of the 3 types of cost, only direct labor and manufacturing overhead. But you know, if you list the equation, it looks like this. Work in process, adding in the 3 types of costs minus the ending work in process, the ones that we haven't completed, gives you cost of goods manufactured. So basically you can just plug in all the numbers here to figure out the red highlighted one, direct materials. Okay, so for this problem you will use direct materials. You can just move everything to the other side of the equation. So you use cost of goods manufactured minus beginning work in process, minus direct labor, minus ending work in process, and then add in the ending work in process. Basically rearranging that equation because you have all the information of all the other categories. Okay, so at the end you should be able to figure out direct materials, 25,300, which means based on beginning work in process, adding in these 3 categories, subtract what's left, gives you cost of goods manufactured. Let me pass this to the back, please. Thank you. Okay, the next question here, number 9, which of the following is a management approach designed to set higher and higher goals in order to make continuous improvement? Total quality management. Okay, remember we talked about different areas of quality cost. You may have internal failure cost, warranty cost, prevention cost. All of these are helping the production cycle and helping them to improve in different stages. So continuous improvement is the theme of total quality management. Okay, JIT is just simply stating that we want to lower down the costs of the beginning materials and also the ending inventory costs. ERP systems, this is a system that helps the business to keep track of different departments' information on a real-time basis. Okay, supply chain management, we haven't talked about this. This is not in the scope of this course. Okay, so this will be D, total quality management. Okay, number 10. Now this one is, within all these questions, this one is trickier, more complicated. Okay, this is testing you on all different activities and see if you can pull everything together, find out different activities allocation rate, find out the different activities cost, and then add them all together to figure out manufacturing costs for one bread box. So if you look at this table here, we have 3 different activities: materials handling, assembling, packaging. First step, we will need to figure out the allocation rate, right? So allocation rate, you need to ask yourself, what is the total estimated cost and what is the driver for that activity? Right, so for materials handling, we have $3,500, and the driver is the parts of the bread box. 5,000 parts is the total estimated allocation base. Assembling, total cost is $12,000. Estimated parts is $5,000. Packaging, $5,750, and the estimated rate is the bread box numbers $1,250. So you can just divide all these drivers by the cost to figure out the allocation rate for each of them. So you will have 0.7 for each part for materials handling, 2.4 assembling rate for that activity. Packaging rate will be 4.6 per box. So notice that all these information here relates to overhead only. So remember, besides overhead, we also have what other costs? Direct materials, we also have labor costs. But this problem tells us that we don't have any direct labor costs to consider. Right? There are no direct labor costs, but we do have material costs for each bread box that costs us $7 to produce it. So you'll be adding $7 plus direct labor 0 plus manufacturing overhead, which relates to these 3 activities. Okay, so if we list them all together, this is the direct materials cost, $7 for each bread box, and 0.7 is the rate for materials handling, but for each box it relates to 4 parts. So you use this rate to multiply 4 parts to represent 1 box materials handling cost. And then again, you use this 2.4 assembling rate, multiply 4 parts again for each box. And the 4th one here, packaging rate, the unit is box already, so you just add 4.6. Okay, so these 3 are the manufacturing overhead costs. This is the material cost for each box. Add all 4 items together, should give you $24. Okay, is this clear or still confused? I notice a lot of you missed this question, so this one is important. Really tests you on whether you understand how to calculate the rates, how to pull them all together to calculate 1 unit cost for each product. Okay, good to move on. Okay, number 11, this corporation uses a predetermined rate to determine its manufacturing company's manufacturing overhead cost. And they already allocated $80 million to jobs. However, the actual manufacturing overhead cost at year end, they figure out, is $120 million. So if we were to close this account, meaning to do the year end adjustments, which entry will we be using? It will be C because we allocated less than the actual cost incurred. So we need to bring up the allocation rate. We need to add it to cost of goods sold. Okay. So again, if this question flips this number, if we allocated $120 million, if we only have actual cost 80, then we'll be flipping these two accounts, reducing cost of goods sold and debiting manufacturing overhead. Okay, number 12. Which of the following statement is not correct? For managerial accounting, which one doesn't seem right, the definition? Managerial accounting is used to prepare budgets, used to plan, control, determine the cost of products and services, so this one is pretty obvious. A is not correct. Right, because the knowledge that are used to provide information to creditors and investors is the one you learned in the previous course, financial accounting. Okay, managerial accounting, we're focusing on providing information to managers level, help them make decisions, plan, controls, and prepare budgets for future seasons. Okay, now number 13, for those who have BD versions, number 9. This company has a whole lot of list of activities happening and allocated costs, allocation basis. But really the question is only asking you about the account verification costs. Okay, only asking you on one particular activity and how much cost will be assigned to one office, Northeast office. Okay, so the information you really need to focus on here is only the account verification. What is the cost allocation rate determined there? And then how do you assign the cost to Northeast? Okay, so we'll be using $15,000, the total estimated verification cost, divided by its driver. The driver is accounts, and the total estimated accounts is 20,000 accounts. So for each and every account, the cost assigned there that relates to verification is 75 cents. Okay, so then the next question would be, what do we use to time this 0.75, 75 cents? So we'll be going back to Northeast office, the accounts occurred there, that needs to be verified is 1,000 accounts. So just multiply that rate by 1,000. Okay, so for each and every problem, when you see them, when you read them, make sure you understand what the question is asking you. Sometimes it's not related to all the other accounts, it's just one particular one. You just need to pick the information that helps you solve the problem here. Okay, moving on, 14. Now this company wishes to sell a truck, and right now they know that the current market price is $400. And they also need to know that they have to accept the market price, meaning that the market is pretty competitive right now. So they have to accept this $400 because this is required from the customer. If it goes above it, customer will least likely to purchase it. Now the current cost for the company is $330 to produce this truck axis, and the company wishes to make a profit equal to 20% of the price. So first of all, what is the profit they want to get? And how do we calculate this? 20% of the price, and we know the price is $400, so that would be $80 is the profit that they want to get. So if you know the set price is $400 and the profit is $80, meaning the target cost is $320. But the current cost they use to produce the product is $330. So what would be the best strategy for them in order to get that $80? Reduce the production cost by $10 per unit. Very good. So why is it not A? Yes, that's very important because the problem already tells you that the current market price is $400 and the company already know that this is a competitive price that customers is willing to purchase. If you go above it, least likely you're able to sell this. Okay, so the best strategy here will be C. First of all, figure out what's the target profit. Subtract that from the target price to figure out the current cost and the target cost. So the difference is here, you know that the current cost is $330, however, the target cost is $320. Company needs to make some strategies to arrange some of the cost allocation in order to meet this $320 target cost. Okay, so some of the areas they need to lower down the costs in order to meet this. So currently their cost is $330. Okay, next question. Which of the following statements is correct regarding ABC systems? Accumulate overhead costs by processing departments. They have separate indirect allocation rates for each activity. They are not as accurate or precise as traditional costing systems. They're less complex, less costly than traditional systems. So they have separate indirect cost allocation rates for each type of activity. Remember, this is the core of ABC, activity-based. We want to not just have one single allocation rate, but multiple ones. Okay, number 16, this tests you on the quality cost portion. So it's asking you which ones of the bullet points here relates to external failure costs. So first of all, you have to know what is external failure costs. These are the costs incurred, remember, after shipping the products. Anything that's within the production cycle relates to appraisal cost, internal failure cost, and before production is prevention cost. So how you determine the answer here, we'll be going through these bullet points and find out which ones relates to after shipping the products, the cost incurred. So how many of them here? Should be 2 of them, and it would be the second one. Warranty costs and also lost profits based on dissatisfied customers. Okay, so the first one, inspection costs, it's testing something, so it relates to appraisal, that $12,000. Inefficient workplace design relates to rework cost. This is internal failure cost. The second one relates to warranty costs, $15,000, and we also have dissatisfied customers. So this $80,000 is also part of warranty costs, and part of the external failure costs. So if you add them together, that totals up to $95,000. Okay, number 17, young company presented the following information. What is the amount of manufacturing overhead cost? So basically, you just choose the ones that relates to this third category cost, manufacturing overhead, and delete anything relates to direct material, direct labor. So if we start from the top, which ones should we choose? Indirect labor, factory depreciation, factory utilities, indirect materials used. Property taxes, we have to choose this because it relates to factory building, right? So everything else, just leave it, add these all together. Maybe pick up your exam. Okay, number 18, spending on testing a product before shipping to customers. This already went over a little bit in the previous example, the previous problem. So testing something and is related to appraisal cost. Remember, prevention cost relates to any cost incurred before manufacturing the product. Testing, reworking represents the appraisal cost, internal failure cost. Okay, so testing a product is appraisal cost here. This company uses JIT system, and how would you journalize paying $6,000 for repair maintenance cost by cash? So first of all, you already know one side of the accounts, cash. If we want to pay something, reducing cash, we will need to debit or credit cash. Credit cash. So the only question left is, what do we debit? Now, JIT system, remember, we have a simpler accounts being used for this system. We merge labor and manufacturing overhead, call it conversion. We also merge the materials and work in process. We call it raw and in process inventory. So what does factory repair and maintenance cost fall under? It will be conversion cost. Okay, so this journal entry, if you want to write it down, it will look like this. Debit conversion cost, credit cash. So this will be D. Okay, the last multiple choice question here. This manufacturing company is considering to produce a new product, and they want to sell. Their target sales revenue is $504 per product. Total cost is $360 to manufacture one product. However, they did a market research and realized that customers are only willing to pay about $462 for this product. So if we want to rearrange the cost, how much will this company need to reduce from their original target cost in order to still have the same amount of gross profit? Okay, so you have the original target sales, the original target cost, but now you know that sales revenue can't be that high because you may not be able to sell your products in the market. So you reduce the sales revenue to $462. And how would you reduce your cost? So the first question to resolve this problem will be figuring out what is the profit in between, the original profit you want to get. Sales revenue is 504, the cost is 360, so the target profit earlier we had was 144. So the problem tells you that we still want to maintain this 144, but we know that the market price needs to be set at 462. So what you need to do is just subtract that 144 from the new target sales price. So this is after doing research in the market. You know customers are requesting this price. You still want to get 144, so you have to somehow try to figure out how to lower down the cost and make it fit 318 in order to get that 144 profit. Okay, so if the new target cost is 318, then the original target cost was 360. You need to reduce $42 to meet this 318. Okay, so you have the original, the blue lines listed here is the original sales, target cost. Figure out what's the profit that you're aiming at getting. This is the new sales revenue that the market is requesting, and you figure out what is the new cost for the product that you need to meet. So then you will compare this number against the original target cost you had earlier. The difference is the part that you need to reduce by. Is this making sense? Are you all lost? I'm sorry, your question was? Okay, this is the more detailed version. You can also simply figure out the differences. Well, basically, 360 is the original cost, right? And you know that the target sales right now, you can figure out also the differences between the new sales and the original target sales. and then just use that differences directly subtracted from the cost. Yeah, but this is a more complicated version, detailed steps. You can also just figure out the differences between sales, and then you have the same difference between costs. That's quicker, yes. Okay, now this is the end of all the multiple choice questions. And for short problems, doesn't this table look familiar? We went over this in class, right? So some of the questions is exactly the same as listed on the slides, so just added 2 more. So the first question, indirect labor costs. Surprisingly, some of you still didn't figure this out. Remember indirect labor costs, all the indirect costs goes into manufacturing overhead. So you definitely will be picking numbers from manufacturing overhead T account. So it has to be the left-hand side, debit side, either one of them. Okay, but also remember that portion comes from wages payable. So we have workers work in the production cycle and help us produce the products, and then they accumulate the wages that the company owes them. So the total wages payable, $74,000, will be broken down into direct labor and indirect labor costs. Remember the ones that closely relates to producing, assembling the products, and the costs incurred, for example, the janitor's salary or also plant managers that can't easily be traced to specific products. So you just choose the 2 numbers that matches, that if you add them together equals 74,000, then that number in manufacturing overhead relates to indirect labor costs. Okay, so that would be $12,000. Now the actual manufacturing overhead cost, the second question here, you just need to add up all the manufacturing costs that you see on the debit side. Those are the ones that incurred. Could be depreciation on the plant's equipment, could be taxes, indirect materials, add them all together equals $51,900. And then the allocated portion is the credit side of manufacturing overhead. So how do we know this? Because you also see the same number in work in process inventory. Right, so $53,900 you credited, and then you debited to work in process inventory. We assign the overhead cost to work in process. So that's how you know this is the portion is allocated. Okay, now the last 3 questions here, manufacturing overhead cost, is it underallocated or overallocated? So remember you need to compare B and C. So C is the allocated ones, B is the actual cost incurred, which you only know by year end. So we know that we allocated more than the actual cost. So this question here, we overallocated the manufacturing overhead cost by $2,000. Okay, and E and F, how do we figure cost of goods manufactured and cost of goods sold? So this one here, some of you listed very complicated calculation, but really since this problem tells you that there's no beginning work in process, there's also no beginning finished goods inventory, really you just need to take a look at the same numbers that has been transferred to the second account. Okay, so if you look at work in process inventory, left-hand side, debit side is all the costs incurred to produce products in a year. Right-hand side, the reason why we will credit it only relates to a certain activity when you finish some of the products, when it turns into completed goods. Then we credit work in process. Okay, so cost of goods manufactured for this business, since it has 0 beginning inventory, whatever is credited there is the completed goods cost and is being transferred to finished goods. So this is what this question is asking you. What is the cost incurred for completed goods? Not the halfway done ones. So just refer to the credit side of work in process. What would the
cost of goods sold?
Yeah.
Why wouldn't it be like 107? Because
Oh, you mean $1 over $9,000, and then you add in also the $2,000? That is a very good point there. So you added in the $2,000 of the over allocation.
Just subtract it because it was over.
Subtract it from. Okay, for those of you that did that, that's the year-end cost of goods sold. Yes, so originally what I meant here was just the ones, if you just look at the chart, you can directly state $109,000. The ones that you credit just in the middle of the section of production cycle. But if you calculate the year-end ones, that also counts. Okay, so keep the ones that you did, $109,000 minus $2,000. Keep your exams, and I'll put them on the top of the pile. Okay, so 109 and 107,000 both works. Okay, other questions on the T accounts? Okay, this next short problem here, we have a few journal entries. So these are the ones also from homework problems. I just switched the numbers a little bit. So the A entry here, if we use materials in production, direct materials, indirect materials, how do we represent this when we use materials? So this is now purchasing, it relates to using materials, so we'll be crediting materials inventory, debit work in process, manufacturing overhead. Okay, now B entry here, if we assign manufacturing wages, the total wages is $10,000, 60% of direct labor, 40% is indirect labor, so you just multiply that percentages by the total labor costs. Okay, so this should give you should be debiting work in process, debiting manufacturing overhead for indirect labor costs, and then credit all the wages payable. Okay, C, allocate manufacturing overhead costs to jobs, and it tells you that they use only one single allocation rate, 250% of direct labor costs. So here from the previous entry, you already know that the labor cost here, direct labor cost is $6,000, so you just use that $6,000 to multiply 2.5. Okay, because manufacturing overhead cost is 250% of direct labor cost. So direct labor costs there multiplied by 2.5. Last one, we transfer the goods that are completed from production. So you know that these are the goods. Originally, the cost incurred was in work in process inventory. Now we transfer them since it's already completed. So we'll be crediting work in process inventory, debit finished goods. Okay, transfer the portion that is no longer halfway done, it's actually completed, into finished goods inventory account. Okay, any more questions on exams?
How do you incorporate the separate questions into like the exam? Like, how do you figure out how much the open-ended questions?
Short problems?
Yeah.
Short problems for each and every account. The debit and credit counts for 1 point, and then the numbers together counts for 1 point. So for this one here is 3. That one here is also 3. This would be 4, because there's 3 accounts here, and then the numbers all together are just counted as 1, because at 1 you get the concept. Concept I think is more important. Okay, and then for these questions, just 1 point each. Okay, so altogether there's 6 short problems questioned in this problem. There will be 6 points here, and then 14 for the second problem. Okay, now if you want to take a look at the distribution in the class, it looks like this. Some of you did really well, 80 and above. There's 12 of you, which is really good. Some of you here, this is not your best work, okay? So a lot of the problems are from homework, or from the slides, from multiple choice questions in the book. You should be able to do better than this. But of course there's second midterm, there's final, there's 7 more assignments. So you still have many chances to improve your performance. Okay, so please try to work harder, especially these people here. All right? Okay, don't look so scared. It's only the first exam. Okay, just keep all your exams. I won't go over them again. For some of you, if you got the cost of goods sold $107,000, that will be correct too. That's the year-end balance of cost of goods sold. So do me a favor, just pin everything together the way it looked like when I gave it to you. And then pass your exams to the front. Okay? That 85% you multiply by 80. This is only the Scantron's problems.
Okay.
Because the machine only reads the Scantron, and then you add the short problem that I gave you. Okay? Oh, that's fine. Okay, thank you. Thank you. Yes. Okay. And we have a little bit of chapter 19 to go over. Oh yes, sorry. Forgot about it. You know what, just put it down. I'll put it for you, okay? Okay, last Friday we went over more detailed analysis on CVP. Remember cost, volume, profit analysis? And we went over some of the CVP charts, went over ratios, contribution ratio, contribution margin, how to calculate that, and how it relates to calculating break-even. We also talked about contribution margin ratio and how it leads to calculating break-even sales. Okay, now last week we stopped around here. Remember sensitivity analysis, we're just taking a closer look at CVP analysis and rearranging some of the numbers, asking some of the questions like, what if we change sale price for the product? Or what if we change variable cost for the product? How will that affect break-even sales in units or break-even sales in dollars? Or we may be rearranging the cost of fixed cost portion. Perhaps purchasing more machines. If we list more depreciation cost, how will this affect break-even sales? So the last part we went over was this table. Remember that when we increase sales price, if everything else is the same, if we increase sales price, our contribution margin will be higher, right? This contribution margin is the portion, the differences between retail price and variable cost. If all the other categories of cost is the same and we just increase sales price, contribution margin is higher, so our break-even point in units would be lower, will be decreased. Because for every unit that we sell, we're able to get more contribution margin than before, so we need less units to break even. So that's the first line listed here. Second, the opposite concept, if we reduce our sales price and the variable cost is the same, fixed cost is the same, then our contribution margin would be not following. Okay, if we reduce the sales price, everything else is the same, our contribution margin is lowered, will be decreased. So if every unit we're getting less contribution margin, then our break-even sales, we have to boost it up in order to cover the fixed costs. Okay, so you have to know the effects by different decisions made by managers, how does that affect contribution margin? How does that affect break-even sales? Okay, variable cost example, if we increase variable costs, now we hire more part-time workers for us. So for every unit we sell, variable cost has increased, but if we don't change the sale price, then the contribution margin again is lower down. So we need more break-evens in units. We need more sales in units in order to break even, right? So the opposite concept, the variable cost decreased, sales price the same, we have higher contribution margin, and our break-even in units will be lowered. Okay, so you understand this by calculating whether contribution margin is being more than before or less than before. If it's less, then break-even units needs to be higher in order to cover fixed costs. If it's higher than before, then break-even units will be lower down. The last category here, fixed costs. Fixed costs, remember, it doesn't relate to contribution margin. Regardless of the contribution margin we're getting, fixed cost is always there and it stays the same. So if fixed cost increases, we have more machines we need to depreciate, this doesn't affect the contribution margin portion, but it still affects break-even units. Because the fixed cost, the numerator increases, contribution margin stays the same, then the break-even sales in dollars will have to be increased, right? Same for the break-even units. If fixed cost portion increases, contribution margin stays the same, then this part here, break-even units, needs to be increased as well. Okay, so some of the relationships when you look at this week when you go back to read the chapter, look at some of the numbers, make sure you understand the relationship between these different areas. How does cost affect volumes? How does volume affect the profit you're getting? And how does these changes in sales price, volume costs, variable costs, and fixed costs, how does that affect break-even in units and sales? Okay, we'll be going over some of the examples a little bit later to help you understand this better. And the last line in this section will be margin of safety. So this is a new concept that we haven't talked about last week. But basically, it's just the differences between break-even sales, the sales that you need to make in order to at least cover expenses, the differences between that and the expected sales or the current sales that your company made. So if your break-even sales was, if you calculated based on contribution margin, at the end you figure out your break-even sales is $1,000, and currently your company is making $3,000 for this product, then your margin of safety is $2,000. Either current sales or expected sales. Okay, so margin of safety really is just any sales amount that you went above break-even sales. The differences portion, the $2,000, is what we call margin of safety. The reason why we call it safety is because this is like a deposit you make up front in the business, like a deposit for rainy days. If this season you're able to make above break-even sales $2,000, that means in the next season, in case the economy is not that well, you're not able to make $1,000, you only made $500. Next season, even though it's a minus 500 compared to break-even, but since last season you had 2,000 left, overall you're not getting operating losses if you average them out, right? So this is just like a safety amount that you made up front. It's like a cushion of sales in case later seasons the business is not going that well, you still had earlier margin of safety stored up front. So you will not be getting losses if you average out total sales and profit. Yes? That $2,000 later at the end will be shift to retained earnings, yes, because it's part of revenue. You're talking about year end will become retained earnings, yes. It could be months, it could be year. Usually we call it could be at least quarterly. Usually you may not be doing this analysis every single month, but it depends. If it's a newly started business, it could be monthly tracking the margin of safety. It could be also fulfilling quarterly reports for public companies, half-year reports, or annual reports. But definitely annual reports, they need to calculate this. Okay, so margin of safety is just the amount differences between the break-even sales that we learned last week. Once you calculate this, compare this against the current sales or the expected sales in the future. Both of these, we call the differences margin of safety. Okay, so it's talking about the sales side, not on the profit side. Simply just the differences between expected sales and break-even sales, or the current sales the company has and break-even sales. As I said, think about the differences as a deposit that a company makes before. Just in case later on the business doesn't look so well, you still have earlier margin of safety to cover this. So this problem here tells you that the break-even sales in events and units, remember the DJ services, we calculated 100 events to break even last Friday. So if the current season they were expecting to get 170 events in the beginning of the year, they did some research, they expect that right now the business is doing pretty good, they may be able to get 170 events from customers, then the difference is 70 events multiplied by each event's sales revenue to get this margin of safety in dollars. Okay, so we look at margin of safety in the perspective of sales revenue, not in profit side. So when we talk about margin of safety, usually it's the sales revenue differences, not the profit differences, because remember, profit relates to the cost, relates to operating income. So usually when we talk about margin of safety, it's in the aspect of sales revenue. Okay, let's do a few problems on the concepts that we talked about last Friday and also margin of safety. And make sure you understand this. For this question here, the Story Park company competes with Splash Worlds and again sells tickets at $50 per person. That's the sales price per person. Variable cost is $10. Fixed cost is $240,000. Now, if they were to change the ticket sales price per person to $40 to increase the number of tickets sold, try to calculate the new break-even point in tickets and in sales dollars. Okay, if you forgot the formulas, everything you need here is on the whiteboard here. So basically, you're just using the $40 now. That's the new sales price, and then calculate a new break-even point. Okay.
Which, since it's going from 50 to 40, you have to do 40 minus 10,
Mm-hmm.
which equals 30.
Okay.
And then after that, you take the fixed cost, which is 240,000, and divide it by 30, and you should get 8,000.
8,000, and this is what?
And that is the break-even.
That is the break-even point in terms of units or in terms of sales dollars? Well, if you use this 30, then it will be 8,000, is it dollars or 8,000 tickets? 8,000 tickets because each ticket variable cost is $30, right? You did this part right. If it's asking you a break-even point in units, then this will be the answer, but then you have one more step to do. Once you get this 8,000, what do you do with it? Tickets. So how much is sales dollars of this? Multiply that by 40, right? Because the new sales price per ticket is 40, right? Thank you. So you have $320,000. This would be the break-even sales in dollars. Now remember that this is one way to do it. We also have another way to do it. We'll be using directly contribution ratio. That's another way. Right? So this way gives you two steps. You calculate break-even units. This is the tickets. Because what you used here in the denominator is variable cost in dollars. The contribution margin, contribution margin in dollars. You can also use contribution margin ratio, which will directly give you the $320,000. So if we use contribution margin ratio, that will be $30 is contribution margin, but you divide it by the new sales price 40, this will give you contribution margin ratio, and then use this to divide the fixed cost. This will also give you $320,000. Remember contribution margin ratio per dollar of sales, how much contribution margin we're getting. So if you calculate this ratio, how much is that? 0.75. Right, so $240,000 divided by 0.75 will give you $320,000. Okay, so there are two ways to do this. You can either calculate break-even units first and then calculate break-even sales. The question actually is asking you both of these. Okay, so you can do it this way or get the sales dollars first. So if you think about this question here, sales price originally is 50. Now we decrease it to 40. Right, so if we lower down the sales price, the contribution margin here originally was 40 and now it's only 30. So originally if it was 40, the break-even units was lower. Right? So if it was 40 earlier, we were getting only 6,000 units in order to break even, the original price. That will be using 40 divided by $240,000 divided by 40. But now since we lowered down the sales price, everything else is the same. Contribution margin per ticket you're getting is only $30, so you need to sell more tickets in order to break even. Okay, this is what this problem is trying to lead you to understanding. If we change some of the strategies in the business, how will this affect break-even units? Earlier it was 6,000 units, now you need 8,000 in order to break even. But each and every ticket you're selling it at a lower price, so it's also likely that customers, if they compare across different amusing parks, they may want to choose yours because yours has a lowered price. You may be able to break even more easily. Okay, using the same example here, but changing numbers in different areas. So if we were to leave the sales price the same, but now change variable cost from 10 to 20. So then how many units do we need to sell to break even, and how much is the sales in dollars? Sales price is the same, now we're changing variable cost. So again, the first question will be getting what is the new contribution margin. It's 10 over 20. Contribution margin ratio. So the sales price is still the same. Okay, sales price is still 50. about the break-even units and sales? Same 8,000 units, but what about sales in dollars? 200,000 you got it from. You will multiply by 50, exactly, because we didn't change the 400,000. So you will need to calculate this by the new contribution margin ratio, which is 50 minus the new variable cost is 20. So it's 30 here, and we divide it by the same fixed cost, 240,000. So it gives you the same units as before, 8,000 units, and then you multiply that by the $50 per ticket sales. Multiply that by 50, because each ticket you're selling it at $50 to customers, right? The beginning part of the problem. We didn't change the sales price here, we're just changing variable cost. So we're changing variable cost to 20. Originally it was 10. Okay? So this is a problem that we didn't change sales price, but we changed the middle of the cost portion. A variable cost increased to $20. Originally it was 10. Now again it lowers down the contribution margin you're getting for each ticket you're selling. So now we're not reducing sales price, but we're increasing variable costs. So it will give us $30 per ticket. This is the contribution margin you're getting for every ticket you're selling. And you use this to divide fixed costs to get the break-even units, which again is 8,000. But this 8,000 units now we're selling it at $50. That's the price that we didn't change. So break-even sales is 400,000 instead of earlier it was 240,000, right? By the 50 is the sales price. So earlier in the problem we multiplied by 40, right? So now it's multiplied by 50. We didn't change the sales price. Okay, yes. That gives you contribution margin, yes. And then contribution margin ratio will be that divided by sales price. Okay? Okay, very last question here. Margin of safety. If Story Parks expects to sell 6,200 tickets, try to calculate what is the margin of safety in tickets and in sales dollars. Okay, so remember, margin of safety is the expected sales minus break-even sales. So the first question you want to calculate here, first problem here would be what is the break-even sales to compare against the expected sales. Okay, so get the break-even sales first and then subtract it from the expected sales here, see if there are any differences. $240,000 divided by 40, you're trying to calculate the break-even sales, right? So you will be getting 6,000. This is the break-even units. And you're expected to sell 62, and you minus the break-even, compare it against that. You realize that this is the additional part that you may be getting, 200 tickets. And then each of the tickets costs $50, so this will give you 100,000. Okay, thank you. I'm sorry, it's 10,000. Yes. Okay, so again, this margin of safety concept can be used for expected sales, or also you can just use that at past season current sales. Is there any differences between that sales amount and the break-even sales? If it's above it, that's what we call the differences portion, we call a margin of safety, because it serves like a deposit for rainy days for future seasons in case there's operating loss incurred.